Hey, good morning, options traders, and welcome back, everyone. A question that I get asked a lot from traders is, when should you choose a debit spread over a credit or a credit over a debit? And it's a good question. There's a lot of different reasons why we might choose one over the other. Unfortunately, most traders think that the credit spread is simply better because you're getting paid for it, and we'd rather have credits than debits, and that is just simply not true. The real reason, or at least one of the main reasons for choosing a debit over a credit or a credit over a debit, has to do with the reduction of either risk or your cost. And to understand why, it helps to understand cheap or chicken. So let's go find out what cheap or chicken is all about. And as always, before we do, please be sure to click like and subscribe. It definitely helps to promote the channel and is greatly appreciated. So let's start off with a debit spread. Remember, for a debit spread, you are going to buy a call and sell a higher strike call with the same expiration. And for puts, you will buy a put and sell a lower strike put. And that's always going to result in a debit. And the reason for this is that there are a couple of pricing principles. One says that lower strike calls and higher strike puts are worth more money. Again, assuming the same expiration date. So we know that they have to be more money. So if you're buying a lower strike call and selling a higher strike call, it will be a debit. If you're buying a higher strike put and selling a lower strike put, it will also be a debit. So these are going to be your debit spreads. So what is it about debit spreads? Well, let's take a look at an example. Let's say that you buy the $100 call and maybe it's trading for 20 bucks. And you're going, well, it seems like an awful lot. Maybe I don't want to spend that much. So maybe I sell the 105 call for 17. Now it's a net debit of only 3. I could do the same thing with the puts. Maybe I am looking at the 105 put currently trading for 10. I could buy that straight up for 10, or I could buy the 105 put and also sell the 100 put, maybe trading for 7, and again, it would be a net debit of 3. So the thing to understand is that with debit spreads, what you're trying to do is to reduce the cost. In other words, you're trying to make it cheap. So for example, looking at the call options here, if you buy the $100 call for 20, there's our bend at the 100 strike, and you can see it sits fairly low in the graph down here at minus 20. That's the cost. So if you sell the 105 call for 17, it's going to shift you from the red to the blue. So now you can see a very big difference between these two profiles. The main reason that we chose the debit spread, in other words, to sell off the 105 call against the 100, was to reduce the cost. We want to shift this maximum loss part higher into the risk graph. Now our maximum loss is 3. Now, as a consequence, we will also reduce our potential profits. Of course, nobody wants to intentionally reduce profits, but the reason we do the spread is to reduce the cost. Now, we also get another little benefit. We can see a crossover point right here where the red and blue lines cross. That's right at 122. So if you bought the $100 call here in red for 20 bucks, you would need the stock to be at 122 at expiration to generate a $2 gain. But take a look at what happens when you do the vertical spread. We can get that same $2 gain down here at a stock price of 105. So that's a 14% reduction in where we need that stock price to be at expiration to capture this $2 gain. Okay, so that's the main thing behind the debit spread. You're trying to reduce the cost or to make it cheap. Now, what about the credit spreads? Well, let's say that you sell the 105 put and you could collect 8 bucks. It's an $8 credit. And all things being equal, yes, we'd rather collect that full credit. But you also realize that if you're selling an option by itself, which is called a naked position, you've got unlimited downside risk, in this case with a put. And so upon second thought, you're going, I'm not so sure I'm wild about having unlimited downside, at least down to a stock price of 0. Let me buy some insurance. Let me buy the $100 put, maybe trading for 5. And now it's a net credit of 3. So we've reduced the credit. We could have had an $8 credit, but we've chosen to buy an insurance policy, so our net credit is now reduced to 3. See, the debit spread was trying to reduce the cost. The credit spread is trying to reduce the risk. So let's go back to this 105 put selling for 8. If you sold that by itself, Yes, our maximum gain is up here at 8. However, we recognize that we've got unlimited downside, and we're not so wild about that. So we say, let me buy the $100 put so that I have the right to sell those shares anywhere below 100. And in doing so, we shift from the red curve to the blue. See, now you can see a very big difference. Our main motivation for the credit spread was to get rid of this. It was to reduce this unlimited risk. Now, of course, as a consequence, just like with the debit spread, we also have to reduce our potential profit. Unlike the debit spread, we actually increase the point where we can make this maximum loss. But again, that's really a consequence of just receiving less money. We're going to hit this, in this example, this minus $2 point much sooner than if we had sold the 105 call naked. But that is something to consider. You are going to hit that maximum loss point much sooner. So now you can see with the credit spread, the main motivation is to reduce the risk. In other words, you're being a little chicken. Now, another thing to understand with trading is to always consider the other side of the trade. The credit spread is the trader on the other side of the debit spread. That's a really easy way to see why it's not better. You're just the trader on the other side. So if you buy the 100-105 call spread, that would be bullish. And if you are the seller, you would be selling the 100-105 call spread, which would be bearish. And what happens is you just get opposing risk graphs like this. So now, here's the bull spread in blue, the debit spread. Here is the bear spread, with the puts, a debit spread as well. But what if you sold the put spread? Now you're the trader on the other side of this trade, and what that's going to do is to flip it and now make it bullish. So this leads to another important pricing principle. There's an important connection between the call and put spreads. And so if you have the 100-105 call spread trading for 3, the 100-105 put spread will be trading for 2. Now, how do I know that? Because these prices over here, in this example, sum up to 5, and that would also have to equal the difference in strikes. So we have a $5 difference in strikes. If you have to pay $3 for the debit spread, you know that the corresponding credit spread will be trading for 2. And because of this, now you can see why there really is no such thing as a credit spread, at least from the broker's perspective. So here is the debit spread in red, the 100-105 for a $2 debit, and on the right is the credit spread for a $3 gain. So over on the left with the debit spread, yes, we have to pay 2 and we can make a maximum of 3. So the broker is going to say, okay, Mr. Trader, I see that the maximum loss over here is 2, so I'm going to debit your account $2 to guard against that maximum loss. However, if you want to jump to the corresponding put spread, meaning the same strikes, just with the puts, now yes, you can sell it for a credit of 3. You now have a $5 obligation, which means the maximum loss is 2, exactly the same as it is for the debit spread. Well, if that's true, well, why not get paid $3 instead of paying 2? This is how most traders think. And here's the reason. Yes, it is true that you get the $3 credit, but because it's a $5 obligation, the broker is going to charge you a $5 margin requirement, which means they're going to withhold $5 or $500 per spread. So if you receive 3 but are charged 5, the net debit is 2, exactly the same as the debit spread. And so unless there's a skew where we're getting different pricing between the call and the put spreads, there is no benefit to taking the debit spread or the credit spread. There can be morphing benefits, there are potential closing benefits, but you don't take it just because you think it's better because of the credit. So which should you use? Well, this is where you can fall back on cheap or chicken. Debit spreads, remember, you're trying to make it cheap. You're trying to reduce the cost of the trade. With credit spreads, you're acting more in a chicken fashion. You're trying to reduce the risk of the trade. So the question comes, which strike do you need to control? Do you want to control the more valuable strike? Well, then use the debit spread and reduce the cost. Are you trying to sell something that might have a very high implied volatility? Is that your goal, to sell an option? And if it is, and you're trying to reduce the risk, well then, use the credit spread and reduce the risk. And so by understanding cheaper chicken, it can help you to understand if the debit or credit spread is right for you. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.